So good afternoon, everybody, and thank you for joining us for this webinar, Business Succession Planning for Middle Market Businesses. Hope everyone is doing well and staying healthy. My name is Mike Camarata. I'm with Ty Creek Financial Group, and I will be moderating today's webinar. I'm joined by three great panelists that are experts in the topic of business succession planning. So before I introduce today's panelists, I want to make sure that everyone is aware that today's webinar will be recorded and will be posted on all of our respective websites. We will have a panel discussion today around today's topic. So for those who were joining and were really excited for another PowerPoint slideshow, we're sorry, there will not be a slideshow today. We will open it up for questions and answers at the end of this discussion via the chat feature. We'll do our best to get everyone's questions answered. We will also follow up with all registrants via email. And in that email, we will include all three firms' contact information, as well as informational content related on today's topic. We will also make ourselves available to speak with anybody who is attending this webinar if you have any questions related to this topic. With that said, let me introduce today's panelists. Brian Haynes, he is the director of Clearview's Income Tax and Advisory Practice. He is an expert in tax compliance and tax planning, including federal, state, and local income tax concerns for both businesses and individuals. He has 2 decades of experience of tax consulting and managing the compliance work of large, consolidated corporate returns with multi-state operations in non-for-profit, manufacturing, distribution, professional services, retail, real estate, healthcare, and construction. Whew, it's a mouthful. He also has experience in tax planning and consulting for individuals and multiple business entities, such as partnerships, LLCs, and S corporations. Brian has enjoyed developing long-term relationships with his clients, where he's relied upon as a trusted advisor to help his clients achieve their business goals. Next, I want to introduce George Nemphos from Nemphos Brown. George has extensive experience in representing and assisting clients in entity choice formation, mergers and acquisitions, private placements of debt and equity, complex joint ventures, structural and day-to-day issues, as well as corporate governance and securities law compliance. Nemphos spent a majority of his career with big international law firms and brings a unique perspective to client issues. He is known for his practical and business-oriented solutions to legal issues. He frequently advises clients in the manufacturing, consumer products, restaurant, automotive, retail and wholesale, industrial services, technology, and insurance industries, as well as companies in the capital markets, life sciences, and homeland security space. Last but not least, Chris Farlata is a founding member and managing partner of Ty Creek Financial Group and is responsible for leading the firm's financial planning, operations, and strategic vision. Chris spends the majority of his time working with the firm's business owners and executive clients, assisting them with their planning, investment, and insurance needs. He graduated from Salisbury University with a degree in business administration and finance, holds several industry designations, including the Certified Financial Planner designation. Good afternoon, gentlemen. How's everyone doing today?
Doing good.
Pretty good, Mike.
Good, good. So let's start with a common question when it comes to structuring your company. You know, the governance, the ownership and ease of planning, you know, what's the difference between a corporation, an LLC, and a partnership? So Brian, why don't we start with you when it comes to that question?
Okay. Yeah, I mean, I'll give you some of the differences from a tax perspective. You know, partnerships have this concept of the 754 election, where you get a step up in basis for, you know, the difference between the fair market value and, you know, the capital count that you're inheriting. And you get to amortize that step up over the life of the underlying asset in the partnership. So that's typically goodwill with an operating business. So you get to amortize that step up over 15 years, where as an S Corp, you know, that's just part of your purchase price. That's part of your base. You don't recover that over time. You know, it just goes into calculating your gain or loss when you sell those. You know, one of the other the big differences between, you know, a partnership and an S corporation is related to when you sell a membership interest in a partnership, you have to, again, look at the underlying assets. They're called hot assets. It's Section 751. And you have to recognize ordinary income on things like inventory, depreciation, recapture for fixed assets. If you're cash basis, it's AR. So even though you're selling your membership interest, you still have to recognize some ordinary income for those underlying assets that are attributable to your share. Whereas S corps just get capital gain treatment if you sell your stock. And there's not really any big differences if it's an asset deal, if you're selling for an asset deal between a partnership and an S corp. But those are kind of the two biggest things just between an S corp and a partnership from a tax perspective.
Gotcha. Thanks for that. George, do you have anything to add?
Sure, yeah. From a legal standpoint, when you're dealing with structure of an entity, your baseline is obviously what industry are you in, what are your long-term goals, short-term goals, and who's going to be a owner in the entity. So when we advise a client as to what entity they should begin with, I'll start there. We take a look at all those factors. There are differences beyond tax between a corporation, a partnership, and a limited liability company. Corporations generally require much more formality in the manner in which they're run. There are securities issues with regard to how you issue stock and the manner in which you interact with your stockholders. When you're dealing with a limited liability company, you're actually governed predominantly by a contract, and you can manipulate or draft those contracts between the parties in such a way as to modify or change, if you will, the manner in which you would otherwise be required to run the entity underneath a corporation. So there's a lot more flexibility in the manner in which you proceed as an entity under a limited liability company. Partnerships, a lot like limited liability companies, it's all contractual in nature, putting aside the tax stuff. And it's that early on decision that you have to make with regard to where you're going to take your company, your enterprise, and setting yourself up for an event where you're dealing with generational issues potentially, or a sale of the company. Taxation comes into play when you actually are selling the company mostly, or obviously there's income tax and things like that as you're operating. But the structure as you're moving forward will start to force you down a certain road. And while it's in concept from a lawyer's non-tax legal concept, relatively easy to change your structure, there are tax consequences that go along with that. Going from a C Corp to an S Corp. Brian could probably talk for an hour, let alone, on that entire subject. Going from partnership to a corporation, there really is a lot less issues. So you'll see a lot of companies set up as an LLC, taxed as a partnership, in anticipation of potentially somewhere down the road being taxed as a C Corp in order to deal with, potentially getting passed through research tax credits and things like that. One thing I do want to circle back with something that Brian said is that, even with regard to a sales transaction in which you are an S Corp and you're selling stock, it is not atypical today to see a buyer request what's called a 338H10 election, which does potentially change the tax attributes of a sale to the seller. Instead of it being capital gains above, there's definitely going to be some sort of recapture, because what the buyer is looking to do is clearly step their basis up in the underlying assets. You see this quite frequently in situations in which a strategic buyer is stepping in to buy the company, and they want to book up the assets, and they're more likely also to riff some of the employees in order to get some synergy going. So, there is potentially some different tax treatment in a sale of an S Corp, because they can come back and ask you for a 338H10 election, and then you go down a whole chain of negotiations as to well, who's going to pick up the extra taxes that the seller is going to be faced with? So it is a step-by-step analysis that goes through it all. I think also when you're structuring companies, or you have structured your company, the structure from which you are going from does limit the way in which you can deal with or reward your employees. And there's a whole different set of rules with regard to that as it relates to how you can do that moving forward. And therefore, it does affect your succession planning and things of that nature.
That's a good point, George. Yeah, we'll certainly get to that later on in this webinar. Chris, you have anything to add?
As far as the structure, I think the structure as far as guidance is important. And I think that both Brian and George touched on that. I think understanding your structure is key because it's going to affect, how you do your planning, obviously, and how you implement some of the strategies I think we're going to talk about later as far as, succession and protection and things like that. But we can probably move on to the next question.
Okay. Well, good, because I'm going to start with you.
All right.
So what should you do to protect the future of your business from the death or disability of an owner or a key employee?
It's a good question. And it obviously is driven a lot by, how your structure is, if you're an S Corp or an LLC or a C Corp. But generally speaking, most people don't enter into a business to fail, and they don't enter into a business for things to go wrong. Right? They enter into a business to do something, hopefully, that they love, that they're going to make a few dollars doing. And they usually are so laser focused on doing the job or getting the contract or getting the office space that they tend to overlook some pretty basic steps that I think are vital to make sure that the business is going to go in a continuous, seamless fashion in the event that you lose a key person or an owner. And the first thing you got to do is you got to talk about it. I've had many a conversation with folks when, the statement is, I think there's something in our operating agreement that addresses that, but they're not overly familiar with what that something is, or if that something is actually in line with what them, their partners, their spouses, their family actually want. So, I encourage everyone to sit down with your business partners, or if you're a sole owner, give some thought to what happens if you can't come to work tomorrow, either because you die or because you're disabled, and then have the plan that you have in place account for that. Typically an operating agreement is going to say that, the remaining partners are going to have the option to buy either the shares or the business interest from the from the deceased partners, either estate or spouse, but they haven't really talked through that. So the first thing I'd say is have a separate formalized buy-sell agreement that says if these events happen, and clearly state the triggering events, whether it's the death of an owner, the disability of an owner, or the voluntary exit of an owner, these are the next steps that need to occur. This is how we're going to evaluate the business. You probably don't want to actually evaluate the business in the agreement, but state what that valuation method is, or agree upon what choices they may be. And then what's going to transpire thereafter? Is it going to be a lump sum sale? Is it going to be some type of installment sale? Is ownership going to be retained by the deceased partner's, spouse or family, or what have you? Or is it going to be some type of trust deed program? And then once you agree upon that, and this is where I'm not going to split the atom, you should probably sign it. A lot of these agreements are actually written and not signed, which is a huge mistake. And then you need to fund the agreement appropriately. Typically, these agreements call for funding either to be capital in the business to make the purchase. Usually, we'll see some type of insurance policy in place. Oftentimes, these agreements call for the policies to be in place, and they're not. So, agree upon a structure. Make sure that the way, and we're going to talk, I think, more about the nuts and the bolts of the types of structures later, but, agree upon what you want to happen. And then make sure that that agreement is both executed and funded with the appropriate either capital or insurance. And that's from a business succession of ownership perspective. As far as protecting the loss of a key employee, very simply, you've got people that run your business and they're very key to your business. If they're not going to be there tomorrow, there's a cost to replace them. And there's a cost most likely of lost revenues. The business should own what's called a key person policy. It's typically a life or a disability policy on that person, to ensure that things go seamlessly while you either search for a replacement or you pay the cost to acquire a replacement, and you don't have a drop off in revenue that could potentially disrupt the future of your business. These things tend not to be done in the beginning when they should be done, and they tend to be done when sort of the bombs are going off, right? When the fireworks are going off, they go, oh darn, what do we have in place? And typically that's not the time to be making these decisions. You want to enter into those types of things and do that type of planning before you need it.
That's great. And George, I'm sure you have seen and written these agreements many a times.
Yeah, I mean, as Chris said, probably the biggest error that occurs in these agreements is that it calls for a key man insurance policy or some funding source, and no one bothers, and they never address it. So that's always seems to be the biggest failure in how they get put in place, and the manner in which these occur, are as varied as there are birds in the air. I mean, it's kind of interesting, to be candid with you. It's something that, pretty much every company needs to think about, every owner needs to think about. How does my company continue moving forward? How do I deal with generational issues? What do I do about key employees to make sure that they're able to keep running? I don't have family in the business, but I don't want the value of the business to fade away because my family counts on it. So we do see a lot of different variations of this being backed by insurance, methodologies built into these contracts. Is not atypical to see within any sort of stockholder agreement, operating agreement, some sort of buy-sell between owners, a structure and methodology whereby not only is there an ability to pay, but the manner in which something's valued. Let's face it, everybody thinks their kid's the most beautiful, smartest, greatest thing since sliced bread. Same thing goes with entrepreneurs and family businesses, the greatest thing since sliced bread. But they all have an intrinsic value that needs to be, calculated. So within these agreements, what we try to do is set up a pretty fair and stable way from which they can ensure that there is a valuation done, that fair market value is obtained, the family or the other members or whomever is able to get what they've invested in out. And so, we encourage real thoughtful review on this with not only financial advisors such as yourselves, but also with tax accountants, like what's the best way to structure this, this buyout clause. And frequently you do see there's going to be someone come in and do an appraisal of the company, evaluation, a payment methodology where it's funded with some sort of insurance policy potentially, with a payment structure utilizing a promissory note, payments over time, something that enables the company to keep moving forward, but enables the stockholder owner to get out and their family get out what they otherwise should receive. Now that's obviously in a death situation. We haven't even touched on, the typical buy-sell agreements that, which probably could also be a whole seminar on how to do buy-sell agreements between, owners directly, and how to structure those and make it so there's a methodology and an ability to do it. But to Chris's point, you can't only think about the way in which you get out. You have to think about how the company and or the other owners are going to actually be able to deliver on you getting out. And that's something that people fall down on all the time.
That's great. Brian, do you have anything to add?
Not really. I mean, it's funny that Chris mentioned how many, operating agreements do not get signed. It's amazing how many I've received when I ask for them that aren't signed. But no, I just say, make sure you have your tax provider involved along the way. We don't want to just be, telling you the tax answer when it's ready to happen. We want to be involved in the planning and making sure we're going through all those steps with you as you're drafting those documents, as George and Chris both mentioned. So.
Yeah. Now, and, I can direct this question to any of you. I mean, how often would you recommend reviewing these agreements?
You want the lawyer to take that one first? I'll tell you, we tell everybody, at least pull them out every 24 months. You don't need to get your lawyer involved. You don't need to get the accountant involved. At least between the owners, the partners, the family, take a look at it about every 24 months. And by taking a look at it, just make sure you know where it is, take a spin through it. There's nothing that clicks in your head. In the situation where there's multiple owners or multiple employees and there's changes, a lot of times you do need to take a look at it from how are you structuring your own estate planning situation, because a lot of this goes into estate planning because it's an asset. It may be the asset of the family. And if you haven't thought through how that buy-sell needs to work in conjunction with your estate planning, in conjunction with your partners, or even in conjunction with your generational planning, and it harkens back to, well, what's the structure of the entity? How do we want to, do we need to make changes to that? Because stuff changes, life goes on, pandemics occur. You got to really think about what your goals are, and has there been a change in those goals? And you now may have one of your family members actively involved in the business, from when you first entered into this agreement or started working through it. And you may need to modify the structure a little bit to provide for some estate planning purposes, and then utilize this as a financing vehicle to be able to pull the asset cleanly out of the state, a fund, a spouse or family expenses, but ensure that the company keeps moving forward and moving on. So our recommendation is at least a checkup review every 24 months, thinking about where you're going, what's going on, what you're doing, and who's involved. And then, following up with Chris, Michael, Brian, to figure out, stuff that's changed. Because as a lawyer, we only know what you tell us, right? I think it's that way with every service provider. We can only give you information based upon what you tell us, but something like this, we would recommend every 24 months.
Okay.
Yeah, that's a very good point. And, to sort of piggyback on that, these agreements are only as good as the dollars that are behind them. So you could put the perfect agreement in place when you're a $2 million company, blink, 5 years later, you're a $20 million company, but you have the capital to buy a $2 million company, right? Because that's what you put in place on day one, and you never bothered to revisit that. So just as you need to revisit the terms, you also need to revisit the financing. And that's not to say that you can't secure some type of promissory note or some type of third party financing. But the cleanest and the easiest and the safest way to do it for sure is to have, your insurance in place. And again, if you did it in the first year, you need to revisit it 3 or 4 years later, because as your business grows, that capital needs to grow too, or you're doing a significant disservice to, the deceased partner's, spouse, or what have you.
Mm-hmm. Okay. Now, we've referenced buy-sell agreements several times already. Before we move forward, Chris, can you give us just an overview? Like George said, we could probably do an entire webinar just on buy-sell agreements. But if you could just provide an overview to those who are listening who may not be familiar with that term.
Yeah. So, and certainly there's going to be points that Brian and George should jump in on, but essentially it's a legal document or a contract, either giving the option or the requirement for another party to, buy the shares of a deceased partner. So in the most simplistic example, Mike and I own a business together, and we have an agreement that says that if one of us passes away, the other is required, or becomes disabled, right? There's a variety of triggering factors, but in the most simple sense, if one of us passes away, the other is required to buy that person's shares from their spouse at an agreed upon valuation method. So there's a couple of ways to structure it. If we had multiple partners, it might make sense to do something called an entity purchase, where the business itself is buying the deceased member's shares and retiring those shares, and the remaining owners are increasing our ownership proportionately by retiring the shares. If it's just a partnership and there's two of us, maybe something called a cross purchase makes more sense, where I have the agreement to buy for Mike, Mike has the agreement to buy for me, and we own policies on each other. A key mistake I've seen is I've seen the agreement possibly written as an entity purchase, meaning our organization is required to buy the shares, but I've seen the policies funded as a cross purchase, meaning I personally am the beneficiary. So in this case, Mike might pass away and our business has the requirement to buy the shares, but I personally receive the proceeds of the policy, and I personally have no requirement to use those proceeds for that stated purpose. Now, I'd obviously have to be a malicious guy not to follow through, but I've seen that where the agreement is written in one way and funded in another, and it certainly creates at least the possibility for things to go astray. So, you really, it seems so simple, but you really want to make sure that what you have on paper is supported by the actions that you're taking from a protection perspective. Another, whether it's cross purchase or entity purchase, both buy-sell agreements, the other area that we've seen a lot of mistakes made is people will have a triggering event in the document that says, I might have to buy Mike out if he becomes permanently disabled and can't come to work. But there's no funding mechanism for that. So now we're going to rely on a lender, or we're going to rely on the business capital, or we're going to rely on our ability to continue to pay Mike even though he's no longer contributing to the business because we didn't put the appropriate policy in place. Sometimes buy-sell agreements actually will require insurance to be put in place, whether it's actually done or not, but you'll see the language in there. I read that from time to time. So just all stuff to pay attention to when you're setting it up. But, I think to answer your question, and I went down a bit of a tangent, which I tend to do, a buy-sell agreement is either the option or a requirement to buy a member's interest or shares based on a certain event occurring, whether it be death, disability, or potentially even the voluntary exit of a business.
Okay. Brian, George, do you want to add anything to that?
Brian, before I jump in, you want to talk about, tax treatment? I mean, I think Chris brought it up, and, about where the cash flows from an insurance policy and how to go about doing it and how the different treatment would be.
Yeah, I mean, anytime if it's funded by life insurance, the proceeds are tax-free, which is kind of nice. With a redemption, you typically don't get a step up in basis. You don't get credit for that because the business itself is buying the shares back. Now you get an increase in your percentage ownership without having to come up with those funds out of pocket, but you don't necessarily get an increase in basis for the redemption like you do with a cross purchase. So, but yeah, I've seen before where, it's funded with life insurance, and, as Chris mentioned, the value of the company continues to increase, but they don't increase their life insurance. And that's something you kind of have to keep an eye on too, as well, just because, I have a lot of clients that get valuations done every year or two to make sure that their life insurance is enough to fund, a buyout, because, they don't want to be partners with that shareholder spouse or whatever reason. That's some of the things that I see.
Yeah, and I'll tell you from our standpoint, talking a broad structure without getting into what we can do if it's a corporation versus a partnership versus an LLC. What we'll frequently do is get within the document the buy-sell in those situations, that the option, it's an option/put, where everybody kind of works together as to what it, are they going to be taken out or not, but then give it actually to the company and the remaining shareholder, such that there can be some tax planning going on. Again, nodding the head to the fact that down the road, it may be a very different company when this actually gets enacted. And there needs to be some good tax planning around the situation and around ensuring that the payments actually can be made. So we try to couch it a little bit in that. And then as step further in that, to the extent that even if there is insurance required, what we generally try to do is have a flat payout of a certain percentage up front, an agreed upon structure for a promissory note for an extra 3 years, and have some security for that promissory note built into the concept, such that the initial payment is the amount of insurance that the company or the other shareholders have. There's your baseline payment. And to the extent that they didn't get that increase in policy in place due to, timing, people forget, everybody hates paying for insurance. We have the promissory note that backs it up. So that way the spouse in, a death situation gets the full amount of the insurance policy, but then has a promissory note already built into the situation that's got some security on the difference between the value and the insurance, just to make sure the company can move forward and the family actually has something they can tie back to. We do a lot of things also depending upon the structure, corporation versus a partnership versus LLC for tax purposes. What we'll quite frequently do that if it's an LLC or a partnership, that if the buyout has not occurred or some portion has not occurred, it becomes merely an economic interest and they no longer are deemed to be members or partners with voting rights and other managerial expectations of rights. It's just an economic interest in which they are entitled to receive proceeds going forward, almost like an annuity. So there are some things that we can put in and that we do put in as secondary triggers to ensure that the company doesn't find itself in the middle of, if you will, a stockholder battle between one stockholder and the family of another, or a bunch of family stockholders fighting over what's left on the bones. So there are things that can be done to built in to nod your head to the fact that people fall down on the job in always going back and looking at it, but also kind of promoting it and making sure that people are looking to do the right thing and circle back and lock down what they're supposed to do.
Okay, that's great. So we had mentioned prior about retaining key employees, and what should you do to reward and retain key employees, and how does that structure change based on the structure of your company?
It's a good question. I think everybody's used to hearing the word stock options, right? So if you're a corporation, you're used to hearing the word stock options. Stock options, what it basically is, it's a security, which is a promise to the ability to buy into the company at a set price on the date in which you've been granted the option. A lot of the play has gone out of that. The federal government kind of woke up a few years back, and we've now got something called 409A valuation requirements. You can issue a stock option today, but it's got to be at fair market value. In order for it to work properly and not have negative tax consequences for the company or the individual, you issue it at fair market value. So you got to go out to a value. The individual is allowed to receive a stock option to buy in at fair market value of a per share. There's things called incentive stock options versus non-quals, which deals with tax treatment and when you get taxed and how you get taxed, which is somewhat complicated, but ISO's generally subject to some limitations. Once you have exercised your option, you've got an opportunity to get some capital gains treatment and not be taxed on the day you exercise. If it's a non-qual, total different analysis. And of course, alternative minimum tax can kick in too, unfortunately. So a little complicated the answer, but you got stock options for corporations. For limited liability companies and partnerships that are taxed as a partnership, not a corporation, an S Corp or C Corp, but a partnership, you can't issue stock options. There's no such thing. The Internal Revenue Code does not actually recognize the concept of stock options or equity options, if you will, for partnerships or limited liability companies. So you have to come up with the next best thing. The next best thing is a profits interest. After all, you own if you own an entity that's being taxed as a partner, you're getting profits. It's all flow through. It all comes back to you on your 1040. You get a K1 from the partnership or the LLC, and it all, whatever your portion is, flows through to your individual income tax return. So it's a profits interest. And a profits interest is a contractual concept that flies under the radar and has the same exact effect as a stock option. A profits interest means that you own a share in the upside value from the date in which you received your interest. So if the company is worth $5 million today, and I received a profits interest of 1% in that company going, from that day forward, I would not share in anything until $5 million, the fair market value on the date in which I came in, was delivered back to all the other owners. I share in the upside. So that is something that does promote, loyalty and a desire to build the company more because I own part of the upside. It's not unlike a stock option. I have an opportunity to build value and own part of the upside. So that's a big one. That's a big area. There are phantom stock options. There's phantom stock plans in which no one owns anything, but you effectively create this pool of money that tracks how the company's doing. And frankly, the tax results on that aren't as good as if you owned a stock option and had an opportunity to own equity, or in the case of a partnership / LLC, had a profits interest. In both those situations of a stock option and profits interest, you actually have a shot, depending upon an exit, of receiving capital gains treatment. In a phantom income pool, it's more or less a bonus pool for your employees that tracks the value of the stock. So it ends up being generally ordinary income. So those are all ways in which to reward your employees and keep them motivated to building value in the company. It really depends upon what your company does and what, if any, limitations there are on stock ownership. There are many industries out there, specifically in the government contracting space, in which there's certain employees that can't own a real interest in the company. They could be foreign nationals. They may not have security clearance for a sector. So it's just a bunch of levers and pulleys and buttons that you can hit in order to keep your employees motivated.
Mm-hmm. Brian?
Yeah, I'll add a couple things. And George stole my thunder there on some of my ideas, but yeah, and one thing that I'll add, the profits interest is not a taxable event when you issue it because you're only sharing the upside. So that's one additional benefit to that. And yeah, I agree. The phantom stock plan is great. It's going to be ordinary income treatment, and that's more just helping with retention, not necessarily succession planning. But and then the other thing you can do is just grant restricted stock units. And when you figure out what the value is on the date of the grant, you can make what's called an 83B election and lock in that value at a lower amount, and then have it vest 4 years, 5 years down the road, and retain that same value on the day that it was granted. So that's another technique that's used quite a bit is the 83B election.
Yeah, Brian, you kind of tipped your hat to something else, and that is, if you're dealing with succession planning, depending upon if you're a C Corp, S Corp, or a partnership, there are some things that can be done. S Corps can't have multiple classes of stock, but they can have voting and non-voting stock. So quite frequently what we've seen is either with a family situation or a key employee, they end up with non-voting stock. And over time, you can make it where the non-voting stock comes up in percentage. The voting stock goes down in percentage as you're trying to deal with succession planning while maintaining control within the founder, the family. And then upon their demise, the non-voting stock can be flipped to voting, and then there's a buyout clause against the old voting stock from the estate. So you've actually over time pulled percentage value of the company out for succession planning, but made sure that there was an opportunity to be able to buy out cleanly the estate. We see it a lot of times when there's a spouse in the business, a son or daughter or nephew or niece, a structure like that. And you can get some of that the same way with LLCs and partnerships. A little more complicated to make it happen, but if you're talking about succession planning along with employee retention, you can build that in to help keep your key employees by figuring out a way to get some of that interest today to them through valuations, loans, things like that, and set it up to trigger that buy sell so the family can quickly, dispose of their asset, get cash for it, and the business goes on and on with those key employees.
Chris, you have anything to add?
Yeah, the one thing we'll see sometimes, and all great information that you guys had mentioned employee retention. The one thing we've seen become popular recently, in addition to non-qualified deferred comp, which allows businesses to put some money aside for their key people and as long as a series of requirements is met, it's then paid out. But as you guys know, with taxes, obviously the issue with the non-qualified deferred comp is the business can't take a deduction up front on any of that money. It's unsecured and unfunded. With the alternative being the old 162 bonus plans, right? Which essentially says that we're going to bonus the executives a certain amount of money. We're going to put the money in some either escrow or third-party vehicle. And if, again, a series of requirements is met, typically it's years of service, that money becomes yours. The business takes the upfront deduction for that. It becomes taxable to the employee. But in practice, it became very difficult if the employee didn't meet the guidelines to claw the money back because it was already theirs on paper. So what a hybrid plan has come about that we've seen a lot of popularity, which is just referred to as a leveraged bonus. It's the old 162 plan, with the caveat being, I'm going to set this up for my CEO. I'm going to set this up for my key person, and I'm going to bonus you the money that we agreed upon, and I'm going to set out a term that you guys need to meet, again, whether it's performance goals or whether it's years of service or what have you. But the caveat being, I'm going to lend you the money to pay the tax on that bonus. So as a business, I'm going to take the deduction. As the employee, I'm going to have to recognize that bonus in my taxable income, but the business is going to lend me the money to pay that tax. And now you as the employee are retained because you're on the hook for that loan that the business has lent me to pay that tax. And if you meet the requirements that are outlined in the document, the business will then forgive the loan, at which point obviously it becomes taxable to the employee, but he or she has that pool of money that's built up, and a portion of it can pay the tax and the rest becomes theirs. And that really gives the employer the control they want in a bonus plan, in the employee retention, but it also gives them the upfront tax deduction that they want, that they don't get in deferred comp. So that's something we've seen. It's not something that's widely used for a group of 10 or 20 or 30 employees, but you might see leverage bonus used for 2 or 3 or 4 key people, 1 or 2, whatever it may be. And it's a little bit outside the box, but it's a great way to reward 1 or 2 key people and then retain them at the same time, where you can still, again, get the benefits of paying compensation out on your employer's tax return and balance sheet, but also have that sort of golden handcuff to incentivize the people that really make the business go to stay, which is we've seen that people really do like that. Now, again, as both Brian and George can attest to, depending on the ownership structure, it might not be a great thing for the owners themselves because they're not going to get a lot of benefit from it. But it's a way to really hang on to 1 or 2 people that you want to.
Good stuff, guys. George, you had mentioned people who are involved in the business. What type of agreements do you need to have if owners are either not family members, or let's say they are family members?
So if it's an agreement amongst owners, I think sometimes it's a little easier to get those agreements in place if they're not family members. Inevitably, you always hear about, well, last night at the kitchen table, or at 3 a.m. he called me. And so, again, first step back, take what type of structure do you have? So if you're a corporation, what we generally say, it's a stockholders agreement, right? Put everything in one agreement on how you guys are going and gals are going to interact with each other on a day-to-day, annualized basis. Stockholder agreements are contracts amongst holders of the security that own the company, and therefore there's a lot of freedom. You can put things in like, well, as long as I own X and you own Y, both of us get to put somebody on the board. And then for that third board seat, we have to agree on who it is because they're going to be the arbiter when we're in an argument. You can put your buy-sell in there. You can even put in, and we would recommend, requirements of basic information within those, anticipating that somewhere down the road, potentially someone's family could end up holding an interest in a company, however big it is, or for whatever period of time, and they're going to need access to financial information. So with a company, we really recommend a stockholders agreement. A lot of people say, nah, it's too big, I don't want to deal with all that. Well, then at least the buy-sell agreement amongst yourselves. But if it's not family, then you really need something that does govern, more about what's happening. Suppose Chris and I own a company together, and it's 10 years in, and I've about had it, and I want to move out to Wyoming and, fly fish and hike. Chris is just hitting his stride, and he's like, no, man, we're going. This is beautiful. Well, I want out. And Chris doesn't want to, to drag me along, nor, me sit there and go, that's great, Chris, send me my checks. And then Chris is doing everything, and he's got to pay me a piece. So, having a stockholders agreement in place where you're not only have a buy-sell, but some sort of protocol where beyond what happens in an event of death or disability or something else, I have an ability, and Chris has an ability, where I say, I'm done. I've been around for a long time. I'm out, Chris. I can say, look, I want to get bought out. Company and you have 6 months to figure out how to take me out. If you don't take me out, Chris, I've got the right to push to have the company sold. A little bit of a Russian, some people call it a Russian roulette, but it's not quite. Russian roulette is, I go to Chris, buy me out. Chris says, no, you buy me out. I'll take that price. So it's, but some mechanisms that enable the owners to split. If it's family, you're not so much considering the split unless there's members of the family who own a piece of the company who actually aren't actively involved in the company. And if that's the case, then yeah, maybe you would want to build something in. Aunt Betsy is a stockholder in Grandpa's company along with my dad. And Aunt Betsy owns 30%. My father has 70%. He runs the company. She gets a check. He's happy as hell to give a check. But her son, Todd, is a deadbeat. And neither my dad nor I want to deal with Todd. So when Aunt Betsy passes away, we got to have an ability to take out Aunt Betsy's stock, out of her estate. So that way Todd takes his money and goes and does whatever he wants underwater basket weaving or whatever. So the stockholders agreement enables you to plan around a multitude of scenarios in a corporate setting. In a partnership, it's in the partnership agreement. In a limited liability company, it's in something called an operating agreement. Effectively, all those corporate documents that make a company a corporation and make all the stockholders know what their rights are vis-a-vis each other get dumped into really one document, an operating agreement or a partnership agreement. So same concepts, different title, but it's really important, really important.
So Brian, George mentioned an owner exiting the business. So I got a couple of questions that are more in your wheelhouse, I think. What are some of the differences between an S Corp and a partnership / LLC related either to the sale of an interest or the transfer by inheritance?
Well, I think I touched a little bit on that earlier. I mean, the biggest thing when selling a partnership or an LLC interest is going to be recognizing that ordinary income, whether if you're selling your membership interest, it's recognizing the ordinary income of underlying assets. Mm-hmm. Whereas an S Corp, if you sell your stock, you don't. So I think that's the biggest difference there with an owner getting out of the business. If they're going to transfer it through inheritance, then the beneficiaries of that owner get the automatic step up to fair market value at date of death. And so, one of the things that we always look at is, all right, do you gift your shares of stock or your partnership interest, throughout your lifetime to your next generation, or do you wait until you pass away and it passes at inheritance? And the biggest difference there, it certainly depends on the wealth of the shareholder, whether they're over the estate, the lifetime exclusion for estate tax purposes. If they're over that, then yeah, it's a good idea to give some of that away during their lifetime and have that grow outside of their estate. If they're underneath of that lifetime exclusion, which for married couples is now 23 million, then yeah, maybe you then just, if it's feasible, hold it until you pass away, and the next generation gets a full step up to fair market value at date of death. So there's some things there you can do, and it, like I said, it depends on the facts and circumstances, but we don't really know what's going to happen with the lifetime exclusion after 2025. It may revert back down, and people that don't think they have an estate tax problem may have an estate tax problem after 2025, unless you plan on dying in the next 5 years. We don't really know what's going to happen. So
yeah. Well, now that the corporate tax rates have decreased to 21%, does it make sense to switch to a C Corp for succession planning reasons or other tax reasons?
That's probably the question I get the most, and the answer I give the most is it depends. Depends on a lot of different things. Whether you want to invest your profits, reinvest those profits in the company, or you want to distribute them to the owners. If you want to invest those profits, it's certainly cheaper to do that with a C Corp because the rates are lower. But if you're going to distribute it to the owners, that it's either going to be a dividend, which is double taxed, or it's going to be officer or owner compensation, which is taxed at your ordinary rate anyway. So you're not taking advantage of that 21%. It also depends on whether it's a multi-generational business, and you're going to keep it in the family and hand it down from generation to generation. If there are plans to sell and not pass it to the next generation, that ultimate sale is where that double tax can occur with the C Corp. So, my clients and talking to clients, they're still leaning towards the S corporation, just because of that double tax. Mm-hmm. The other thing is with S corporations and partnerships as well, with tax reform that happened in 2018, you now get a free 20% deduction on your income for a lot of different businesses. They excluded service type businesses from that, such as the accountants and the lawyers and the people on this webinar. But, for the most part, that can drop your effective rate. If you're in the top bracket of 37%, that drops your effective rate down to 29.6%. So there's not that big of a gap. There's still a gap, but it's probably not worth the double tax. So we've been kind of still leaning towards S corporations for most small to middle market businesses.
That's good info. So Chris, I'm a business owner. I've had it, I'm ready to retire and I want to sell. What is it that I need to do before I find a buyer to purchase my business?
Well, do we have another hour? No, I mean, I think it's a similar answer to, what you're going to do when you go into it, right? I mean, I think you need to figure out who your buyer is. I think you need to figure out if you're leaving the business entirely. I think you need to figure out if you're going to be somewhat involved. I think you're going to need to figure out if you're selling internally. I think you're going to need to figure out if it's a third party. Are you selling because you have to, or are you selling because you want to? And then it becomes a function of valuations, financing. I mean, there's a lot of moving parts to it. That frankly, I'm sure George is going to have some stronger opinions on than I am. But so many of these things that we address can be tackled with just a little bit of foresight and a little bit of proactive planning. When you make a decision on the 1 yard line, it tends not to be the best decision.
Yeah, I echo Chris. I mean, if you assume that it's an owner looking just to get out, I mean, I'm done. I've been running this thing for 30 years. Really don't have anybody, I'll give some stay bonuses, some transaction bonuses to keep some people around. Once you make that real decision, you got to circle your wagons. You need to talk to your financial advisor, talk to your accountants, understand, is this a life-changing event? For the good? Is it going to make things flat? What's going to happen? Is it an opportunity to do some more planning? Once you've figured that out from a personal standpoint, frankly, you got to clean your house. I mean, it's amazing to me when people go to sell their companies and they've taken no time to really step back and clean up their company. And by clean up, I mean, make sure your books and records are right, deal with the issues that you need to deal with, make sure stuff's documented, go get a phase 1, just so you have it, things like that. Go get I haven't had an audit in 10 years, and my cousin, has been doing our books through QuickBooks, and the adjustment, there's the bucket of it just called adjustments, So I mean, so you wouldn't sell your house without cleaning it up, making it presentable, maybe paint it, fix the hole in the roof that's so obvious from the street. A lot of people don't take the time to do that with their businesses. And so once you make that decision that you intend to sell your business, whether it be to externally or internally, take the time to clean it up, pretty it up a little bit. Make sure you know where the bodies really are buried. Make sure you know which bodies you need to rebury. You will do better for yourself in the long run by taking the steps that you would normally take for the sale of your house or even the sale of your car. I mean, everybody takes their car to the car wash and at least vacuums the damn thing out before they try to show it to somebody on Craigslist. So do the same thing for your company. And then it flows over to your finances. Do the same thing for your finances. Talk to your financial planners. Talk to your accountants. Understand what this is going to do for you and what you need to get out of a sale. That may govern whether or not you sell at all. Or it may be, oh, hell, I really can sell and not really worry about a lot of stuff. So, as they say, poor planning results in poor results. And poor planning can also lead to, having the conversation with a buyer of MPYP, not MP, not my problem. That's a YP. That's your problem. And when you probably, with a few little things, could have fixed it and gotten more money at the end of the day.
George, you make an excellent point that I just want to jump on just for a half a second. I mean, so many times when we're engaging folks, they want to do a specific type of planning for their business. But as an owner, whether you're, in the middle of your career, at the end, or at the beginning of the stage of the business, understanding what you need the business to produce for you to achieve your personal goals outside of the business is so key to how you actually manage the business and how you structure your compensation and how you structure your incentive plans to keep your people. And when you understand the personal side of things, which business owners tend to overlook because they are so laser focused on doing the thing that got them in that business, it really gives you some insight on how you should actually manage your business. And I would say that, you need to know that in all facets of your business cycle, not just when you're ready to sell and say, how much do I need to, be able to go live, on that ranch in Montana? How much do I need at 50 to pay myself? What kind of revenue does my business need to feed me the way I want it, to let me set the things aside that I need to allow me to provide my family and live the lifestyle that I want? And that'll tell you what type of distributions, what type of compensation plan. So I think that tends to get overlooked because they're just so into doing what they do so well that they worry about their own stuff at home, right? The business is their baby. But I would really say, if you own a business and you're looking at this, take a look at your own financial plan as it relates to your business, and that'll give some clarity on how to actually run the business.
Yeah.
Great.
So Brian, I'm gonna ask you to bring it home here. Let's say, everyone on this webinar has listened to everything that we've told them to do, and here they are. They've built this very successful business, and because of that, they now expect to have a pretty sizable estate due to the successful business. What are some strategies for business owners that do expect to have a taxable estate because of this?
I'll try to condense this because that's probably a long answer. And as we wrap up, but a couple of different strategies is the GRATs and the Grantor Retained Annuity Trust, where you can transfer it to a trust and take back, an annuity for a certain period of time, whether it's 7 years, 10 years, and lowers the gift value of that transfer to the trust. And then it grows outside of your estate. So that's certainly a popular technique. Using family limited partnerships, and people can get really aggressive on discounts and the IRS can hammer them for that, but you could take some kind of discount where you gift it into a family partnership. The kids then pick up their share of the income that they've received from that membership, partnership interest. But you can at least get some kind of discount, maybe 10% discount or 20% discount. There's another strategy called, selling to an intentionally defective grantor trust. And this is a technique where it freezes the value of the company right now, and you sell it to the trust and you take back a note. And it basically, that's the biggest advantage, is it freezes the value of the company, but you also continue to pay income taxes on the income of that company, even though the trust, the grantor trust, owns it. So it can further reduce your estate because you're paying the taxes on it. The trust is getting the money to pay you back the note. You typically set them up so that the note payment is very similar to the cash flow that the company's generating, so that it can pay the note to pay you back. At the end of that note, then the trust then owns the business, or you can do a percentage of the business, and it's outside of your estate. So there's a bunch of different things we can do. We're going to look at credit shelter trust as we get closer to 2025, when the $11.5 million exclusion gets, we don't know what's going to happen to it. So a lot of people are going to use trust to use that full 11.5 million. And if it reverts back, then, they've gotten value out of their estate. So there's a bunch of different stuff that you can do that could be a separate webinar in itself too. So.
Great. Well, we are a couple minutes past 1. I do want to give the audience the opportunity to ask questions. Now, it looks like the chat feature is not enabled, but you do have the ability to raise your hand if you would like to ask a question. Guys, you did that good of a job. No one has any questions. So with this, we would like to thank everyone who attended today. Really great stuff, guys. I think we all really appreciate your insight on this topic and all the different things associated with it. Like we had said prior, this will be recorded and it will be posted on all of our respective websites. You can also expect a follow-up email with our contact information, as well as some just general information pertaining to this topic. So with that said, thank you, everyone. Stay safe, be well. Hope to see you soon.
Take care.
Thank you.
Thank you.
Take it easy.